All right, so let's take a look and see how stocks are doing. We are up 163 points. We are solidly in the green. Let me tell you guys, it has been a wild couple of days here at the New York Stock Exchange where we've seen really wild swings, but it looks as though this idea and the fear about a possible trade war between the US and China seems to be, at least from Wall Street's perspective, seems to be subsiding somewhat. People are just sort of now coming to terms with this idea that it could just be a negotiating tactic between Trump and China. I want to bring in Chris Gersch, Director of Strategy at Bell Curve Capital, who joins us live now. So Chris, thank you so much for being with us. So at this point, how real have the concerns been about a possible trade war? Are they still there, or have they dissipated completely?
Well, to give you a little insider knowledge, obviously, why I'm here is a lot of the outflows from the SPY contract, which is an ETF that tracks S&P futures trade here at the CME, has been on the retail side. So a lot of the smart money has stayed in, and what you're seeing is that we've been up over 100 handles in the S&P futures. That means that, 100 points to the high side from those lows. So a lot of institutional buying, and so I'm going to go with the street and say, hey, this is an opportunity to buy, and we're seeing that volatility tick a little bit lower.
Okay, so it's an opportunity to buy, but the fact that we've seen the wild swings in the first place, is that the new normal? As we don't get clarity on what the US's position is when it comes to trade and a possible trade war, without clarity, can we expect this type of volatility more frequently going forward?
Absolutely. I think actually this is the old normal, so to speak, because volatility being above 18 in the VIX is kind of standard. We are at historical lows the last 2 years. This is normal for us. And so it might take Trump being on Twitter to get it up above that 18 level, but this is the normal, and this is the way I believe the market should behave.
So for ordinary investors who are seeing this, especially people who are close to retirement, who are living in this climate where there are so many fears and so much uncertainty, how do you handle that as an ordinary individual investor who is close to retiring?
Yeah, as an individual investor, it's important to scale into each individual position and to have those set stops. So ultimately, the equity and the high risk, the risk associated with equity investing, that should be really considered as a portion of your portfolio that you can lose. So scale into those positions. Don't buy all at once, and obviously take into account some of the things that you're heavily involved, invested in, that you have an interest in following, so that ultimately you're engaged continuously. But having that risk amount that you can risk to lose, that's paramount before you start dreaming and spending that money on the market going up. You need to know what you're willing to throw in as a loss first.
All right, Chris Gersch, live for us there. Thank you so much.